tell us where you think the economy is right now. We got a raft of eco numbers in, CPI and others this week, that some people interpret as indicating that maybe actually the Fed is having its way, that the economy is softening, inflation is coming back down.
I think it's very hard to read, David, but I think I see some growing evidence of stag, but some real continuing concern about inflation as well, and that's a tough combination. On the stag side, it does look like defaults are rising. It does look like the flow of credit is coming down. Headline retail sales were not strong, although the internals are less clear. So I think you have some grounds for concern about what's happening with real activity on a forward-looking basis. And while the CPI and the PPI numbers surprised a bit in a favorable direction, you saw one-year inflation expectations from the University of Michigan pop up, and the Atlanta Fed wage tracker, which I actually think is a better indicator of what's happening in the labor market than the monthly average hourly earnings, that popped up a bit last month as well. So I think we're still looking at a very hard to read economy. I don't see inflation as on a secure path down to the 2% target unless the economy turns over a bit. So I think the Fed has very difficult choices ahead of it.
So, Larry, let me make it even more complex, perhaps, and that is where we are with credit right now. There's a lot of reports right now that credit standards are going up in the wake of those bank, if I can call them tremors, that we had. How do you factor that into it? Could that help the Fed a bit, really curtail some of the inflation?
Look, I don't think there's any question, David, but that some Fed work is being done by tightening of credit. So there's definitely that effect. The question is, how large is it? I thought prior to the tremors in the banking system that there was a chance the Fed funds rate would have to get up to 6, and that it was certainly more likely than not that it would have to get to 550. What's very hard to know is whether that action in credit, which is reinforcing the Fed, whether that's 3 moves worth of reinforcement, whether it's only 1 move worth of reinforcement, and that's the judgment the Fed's going to have to make on an ongoing basis. I'm surprised still that markets are expecting as large a set of rate cuts over the next 2 years as is currently priced in, because it seems to me that we're not very likely to get 6 or 8 rate cuts over the next 2 years unless the economy is headed towards recession. And certainly recession of a substantial sort is not what's priced into the stock market or, for the most part, priced into high yield credit.
Larry, let's talk about something we haven't talked about that much, which is oil. There was reporting by Bloomberg this week that really suggested there is something of a rift growing between the United States and Saudi Arabia, that if anything, Saudi Arabia is getting closer to President Putin in Russia. And the question is, what does that do potentially for the price of oil and therefore at least headline inflation? How big a problem do you think this is potentially?
Look, I think what's happening in the Middle East, and it's the Saudi Russian thing that you just referred to. It's the Chinese brokered restoration of diplomatic relations between Saudi and Iran is a symbol of something that I think is a huge challenge for the United States. We are on the right side of history with our commitment to democracy, with our resistance to aggression in Russia. We are very much on the right side of history, but it's looking a bit lonely
Larry, I know you spent the week at those meetings, the IMF and the World Bank in Washington, D.C. What did you see? What did you hear about that very subject? That is, the extent to which maybe we may be breaking up into, if I can call this, trading blocks, where people trade with one another, but actually we're moving away from globalization. We're not necessarily all on the same page.
I think there's a growing acceptance of fragmentation, and maybe even more troubling, I think there's a growing sense that ours may not be the best fragment to be associated with. Somebody from a developing country said to me, what we get from China is an airport. What we get from the United States is a lecture. We like your values better than we like theirs, but we like airports more than we like lectures. And so I think that what's at stake in some of these really technical discussions that they're always having here about debt relief or about the future of the World Bank is not just a bunch of stuff about lending money to promote different economic activities or to make development more sustainable, but what the broad structure of the system is going to be. And if the Bretton Woods system is not delivering strongly around the world, there are going to be serious challenges and proposed alternatives.
Larry, your name came up actually in connection with these meetings as people noted that the IMF is really having a different projection on long-term interest rates, particularly the neutral rate over the longer term, saying it's going to come right back down to pre-pandemic levels, whereas you have been saying that's not necessarily the case. Where are you on that issue?
Look, I was, in a way, glad that the IMF was resurrecting and talking about the secular stagnation theory that I pushed so hard between 2013 and 2019. And certainly I recognized all the various arguments they were making, and it's certainly possible that they will turn out to be right. My own sense is that given the huge volumes of government debt that have been run up, given the very large flow deficits that are in offing, and given the large amounts of private investment that are going to be devoted to the renewable energy transition and devoted to friendshoring and increasing resilience, my sense is that the balance in the supply and demand for funds is going to be more towards demand, and that's going to mean higher real interest rates going forward than we had before the pandemic. And so I'm not expecting that we will see a huge return to the secular stagnation situation.
Larry, in your opinion, how does money supply figure into your analysis of the economy overall? There was a lot of talk this week by some economists actually saying that, in fact, the fall in the money supply, particularly M2 with respect to the United States, really indicates that, in fact, we're going to go, if anything, into a recession, that we're not going to have to worry about inflation anymore.
David, I would describe myself as post-monetarist. I think when we started paying interest on reserves, and so if a bank or somebody had an account at the Fed, it was kind of just like a interest-bearing account. And so money was no longer special by virtue of not paying interest. When we had that change in our economy, I think this whole concept of monetary aggregates as substantial predictors of what's going to happen lost a lot of its force. And so I'd have to say that money stock is pretty far down on my list of indicators to follow.
Larry, we'd like to do a few long-short analyses here for you, and let's take a few of those right now. First of all, having come from the IMF and the World Bank, are you long or short on the global economy overall? Janet Yellen seemed to suggest it's in better shape than we thought. At the same time, some people from the IMF were saying we think it's pretty shaky.
I'm probably closer to the IMF, but it depends a lot on how lucky we are. It depends a lot on the choices that are made in the next 6 months.
And Larry, sticking with the IMF for a moment, if we could, you mentioned before sovereign debt relief. I know that was a big topic of conversation for you all in Washington. Are you long short on meaningful sovereign debt relief for the poorest countries?
Short in the short run, long in the long run. It will come, but these things always take time.
Okay, and finally, let's turn to football. We usually talk about golf, but football in Washington, where you've been this week, we have the Washington Commanders now going for a record price of $6 billion to a syndicate led by a co-founder, actually, of Apollo. Are you long short Washington professional football?
I've spent enough time in Washington to have some loyalty to the Washington Football Club, now known as the Commanders. I think this is an important moment for rejuvenation and renewal, and I wish Josh and his colleagues the best.